What's up everybody, Gen X Dividend Investor here. In this fun video I show you that I finally achieved a lifelong investing milestone of $100,000 per year of passive income from a conservative blue chip dividend stock portfolio. And if you like dividend investing videos, then please show your support by hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification. If you want to jump straight to my portfolio details, then you can use the timestamp on screen, but I recommend that you listen to my short preamble, as I'll share some new stuff I've never spoken about before. I won't go over all my background in this video, so if you're new to my channel and you're interested in learning about all that, then I recommend you watch What I Learned Living on Dividend for 2 years, where I talk about how I made my money, how I've been investing for 3 decades, etc. That being said, one thing I will share is that a goal I set for myself at 21 when I graduated from college was to retire in my 40s. To accomplish that, my first thought was that I needed to save lots of cash in the bank so I could live on savings and interest. I mean, my dad always told me how important it was to save money, so I assumed doing that would allow you to eventually retire. Plus, interest rates were high in the 80s and 90s, so you could seemingly make a lot on interest alone. Like, take a look at these CD rates back then. In 1984, a 5-year CD was 11.6%, and then through the 90s, CDs averaged around 5%, which still seemed good. I'll never forget how amazed I was as a kid to learn from my dad that banks paid you to store cash in them. I also remember my dad complaining about how prices kept going up due to inflation. This chart shows you inflation percentage in yellow versus federal interest rates in blue over the last 40 years. What you'll see is that inflation rates move pretty closely with interest rates, and so an obvious problem is that even if you're getting interest from your cash sitting in a bank, that payment is often getting cancelled out by inflation. And of course, the reason interest rates were so high in the 80s was due to high inflation, kind of like what you see happening these days, and as inflation goes down, then rates should go down. Anyways, back when I started my first job, I didn't know any retired folks, other than my grandparents, who seemed to barely squeak by on just savings and Social Security. I never saw them splurge or go on vacations or anything. Fortunately, some coworkers clued me into investing in stocks. I remember being kind of scared to put my money into the market at first, because I didn't like the possibility that my investments could decrease in value, but I learned that over the long run, most stocks tended to appreciate faster than inflation, and so in theory, stocks would be a faster and more reliable way to retire. My grandparents died when I was relatively young, and that's part of the reason why I decided to set a goal of retiring in my 40s, i.e. I wanted to be able to be free from the shackles of needing to work while I was older. Plus, I loved having free time to play video games and watch movies and stuff, so the sooner I could get out of the rat race, the better. Now, one of the defining financial moments in my life was seeing that first dividend payment on my statement, and even though it was small, it was exciting and new. My coworkers had never talked about dividends, so researching how dividends worked and what they were became fascinating. I only had a $30,000 salary at the time, so I ended up investing just a few grand a year, but I dreamed about making enough money on dividends that I could one day retire on them. But while I had a few dividend stocks, I still focused primarily on high-growth tech stocks. That turned out to be a mistake due to the upcoming dot-com crash. In the late 90s, I learned a business term called BHAG, which stands for Big Hairy Audacious Goal, and was coined by a business book author. A BHAG is meant to be a hard-to-achieve, long-term goal for an organization. Like Microsoft's BHAG was to see a computer on every desk in every home, obviously running Microsoft's OS. Note, I'm long Microsoft. Starbucks, which is another company I'm long in, had a BHAG to become the most recognized and respected consumer brand in the world, and I'd say they're well on their way. You can have BHAGs as a person too. Like, maybe you have a goal to make it to the NFL, or to get promoted to the CFO at your job, or whatever. A little while after I learned about BHAGs, the dot-com market crash happened, and after seeing how conservative stocks held up so much better than most everything else, I decided I'd concentrate on safer dividend stocks more, and I created a big, hairy, audacious goal for myself to make a 6-figure dividend income from quality investments. Now, I also had other financial goals I set, like I wanted to create generational wealth so that someday my eventual kids I intended to have would be ahead in the financial game, as well as wouldn't ever feel financially insecure, like I felt on multiple occasions. I've never inherited anything or won anything, so being able to give my kids a leg up was something that really motivates me to this day. And to create generational wealth, I figure I needed to own companies that had longevity, made products that people liked, were leaders in their industries, had strong financial track records, had paid dividends consistently for many years, etc. I recognized that high-yield stocks might let me hit some of my income goals faster, but in the long run I knew that they would most likely underperform conservative low-yield stocks, so that's why I've invested mostly conservatively for the last 30 or so years. So it was really exciting for me when Caterpillar announced an 8.3% dividend hike a few days ago, because that finally pushed my annual dividend income over $100,000. And then after that one, Realty Income followed suit with their own dividend hike, though it was much smaller. Now early on, I wasn't confident that I'd ever be able to get to $100,000 annual income from conservative stocks, and in fact today, my two largest positions in my portfolio are also my lowest yielders in Apple and Microsoft. I made a video called Why I Choose Not to Make $325,000 on Dividends to explain to newer subscribers why I prefer a lower yielding approach, even though I obviously know of high yield tickers I could go with. But my goals go beyond just income. Sometimes when people see my portfolio, they'll look at its relatively low 3.5% current yield, and they'll say that a 3.5% return sucks, but they won't be considering how I've gotten over $1 million of stock appreciation and dividends in just a few years. I say a few years because I completely sold out of all my stocks and then bought back into them a few years ago, and you can watch that emotional video I did called The Time I Sold All My Stocks. So before you leave me a comment telling me about how your 5% checking account interest rates are so much better than my dividends, I encourage you to reflect a bit on why I might choose to stay invested in stocks rather than sell out when the rates go up a bit. Okay, let's take a quick gander at my dividend portfolio in Fidelity, and then I'll show you a better summary view in my portfolio tracker spreadsheet. And here's my Fidelity overview page with some sections blacked out. I took this screenshot before the market opened on Tuesday, June 20th. As you can see, I have three main dividend accounts that add up to about $2.85 million US. My IRA has $1.27 million of dividend stocks in it, my taxable has $1.4 million, and my wife's IRA that I manage is at $171,000. And for fun, I took a screenshot of my Fidelity account in their app and also blocked out some account numbers. I had transferred into Fidelity from E-Trade in February of 2021, so that's why the left side of this 3-year performance graph looks like that. It's pretty neat to see my portfolio value trend up, even though I've been living on dividends for years. Okay, now I'll switch back to my computer, and I'll show you the dividend view of each account, sorted from lowest position to highest, so that I can just quickly show you the totals. About 60% of my dividends come from my taxable account, almost all of which are qualified, and given I have no 9-to-5 job, it means that those are basically tax-free for me. I also often do early withdrawals on my retirement dividends, which means those get taxed like wage income along with suffer a 10% tax penalty. But it's awesome to finally be able to make my retirement accounts productive, even if I have to pay some early withdrawal taxes on them. Okay, so these are the larger positions in my taxable account, and if we look near the bottom of the page, we see that there are about $1.4 million of stocks in it, and this account generates over $58,000 a year of dividends, most of which are qualified, though I also have EPD in there, which should be mostly tax-free for almost the next decade, as it's mostly return of capital, from what I understand. So in this account, Microsoft is my largest position, and I hold $128,000 of it, but it only generates a bit over $1,000 a year of dividend income. My next largest position is Enterprise Products Partners, an MLP that generates almost $9,400 a year for me. After that is Altria, which generates a whopping $10,600 a year in dividend income. Next is $109,000 of J&J, and it generates about $3,100 a year. Going up the list, we see SCHD, then BTI, Pepsi, ExxonMobil, Chevron, Philip Morris, Duke Energy, AbbVie, Coca-Cola, McDonald's, and this screenshot ends with $46,000 of Procter Gamble, generating $1,100 a year. I won't go over the smaller remaining positions in this account to keep things moving, but you'll see summaries when I show you my entire portfolio in my spreadsheet. Okay, and here's a subset of my IRA dividend income in Fidelity. Again, this is sorted such that my largest positions are near the bottom of the screen. You can see this retirement account generates about $34,000 a year in dividends, and it holds $1.27 million of dividend stocks. On the bottom you can see I have about $246,000 of Apple, generating $1,200 a year. Next is $141,000 of Microsoft, generating $1,100 a year. Then I have $125,000 of Realty Income, generating $6,200 a year. Going up, we see McDonald's, Goldman Sachs, Pepsi, Caterpillar, Coca-Cola, Toronto Dominion Bank, Southern Company, ExxonMobil, Kimberly Clarke, Duke Energy, J&J, and AbbVie. There are a few more, but these are the biggest ones that fit on a screen. Then we move to my wife's IRA, which is much smaller, so it fits on one screen. It has $171,000 in it, and it generates about $7,000 a year. Now, one thing to be aware of is that Fidelity doesn't reflect dynamic currency fluctuations, so its annual dividend estimates are less accurate than my spreadsheet, which does take that into account. If you add up the total dividend income in Fidelity, based on these screenshots, it would put me at $99,383 a year, but in my spreadsheet it's more correct at $100,011 a year due to more accurately reflecting currency, which impacts my BTI and TD positions. So now let's jump into my spreadsheet tool, which has all this info plus a lot more, like my overall average weighted portfolio yield, dividend CAGR, beta, PE, how my dividend income is estimated to grow over time, what my portfolio sector composition looks like, and a ton of other things. And because I take screenshots at different moments in time on the same day, you might spot minor variances here and there. So these are the first page of my stocks, aggregated across all my accounts, and ordered from largest position to smallest. So like in total I have 1,738 shares of Apple, and it's 11.28% of my overall portfolio. Thus I have $321 grand of Apple, and it pays out $1,668 a year. Next up is Microsoft at $269 grand, generating $2,137 a year. Then is Realty Income at $173 grand, and it yields $8,654 a year, which is $721 a month. And since I took that screenshot, I actually increased my dividend income a bit more because I bought a tad more Realty Income with my McDonald's dividend that just came in. And yes, Realty Income was the stock I ended up adding to my taxable account, though I may still add Devo or Jeppy at some point in the future, as I've gotten to my income goal with only blue chip companies, so now adding some income tickers is a bit more compelling to me. Anyways, even though Realty Income isn't as tax efficient as qualified dividends are, they are still good enough for me at this stage of my life, and it's my wife's favorite investment, so there's that, though I was tempted to buy BTI as I calculate it's quite underpriced. I've stopped aggressively investing into my account since I'm living on dividends now, but whenever I have spare investable cash, then I'll DCA into reasonably priced things. But even if I never buy anything else, I'd expect my dividend income to keep trending up, which is what often happens with good dividend stocks. Like next month I'm guessing I'll get a small dividend hike from Duke, maybe 2% or so, and in the month after that I expect maybe a 5% hike from Altria. Later in the year I expect Microsoft to announce a hike, maybe 10%, along with a small one from Philip Morris, and probably others after that. Beyond those, I think I might be getting some additional dividend income from the Kenvue shares I think I'll be getting from J&J. But sure, now and then I'll have to suffer through a dividend cut or suspension, but those are rare occurrences when you hold great companies. Like in the 4 years I've been on YouTube, I think I've had 2. So around 100 raises versus 2 cuts is a pretty awesome ratio in my book. And as I've told you in previous videos, owning international companies usually means volatile payouts, so even though they haven't necessarily done a cut, your payouts don't always stay the same or go up, unlike what normally happens with dividend aristocrats and kings. And the same can be true for some dividend ETFs, i.e. their payouts can be bumpy. Like look at SCHD's dividend history on Seeking Alpha. See how it's going up and down from payout to payout, even though the overall trend is slanted up? I explained that happens in my SCHD video, and elaborated with data showing how SCHD had a 70 cents per share per quarter payout, followed by a 52 cent payout, etc. So I wasn't surprised yesterday when SCHD announced a relatively lower payout than most people were hoping for. I mean, if you looked at SCHD's algorithm, then you would understand that some stocks go out, some stocks go in, and with their various changes, then it isn't a guarantee that dividends only go up. Now, they'll probably still trend up over time, but that doesn't mean every quarter or every year it will. And if we have a really bad economy, or if we have black swan events, then there's a higher likelihood of some cuts or suspensions, and that's the nature of investing. SCHD is still my favorite dividend ETF, and part of its strength lies in its reconstitution, but again, don't take that to mean infinite increases. It'll be bumpy. Bottom line, the more you learn, the less surprised you should be, and the more you can anticipate and plan for things. The reality is that the whole stock market can be bumpy, and that's part of the reason why I love getting actual dividend cash into my pocket for my investments without needing to sell them. And if a company of mine cuts their dividends, which SCHD didn't do, then I'll probably sell it and go into something else. Anyways, let's continue on by looking at the other page of my stocks, and we'll look at the bottom summary rows. We can see that I have 31,412 shares of stock, and on the day I took this screenshot I ended basically flat at up 0.02%. My estimated annual dividend income is a tad over 100 grand, and my portfolio's average weighted starting dividend yield is 3.51%, and my portfolio's average weighted 3-year dividend CAGR is 7.29%. You can also see some of my smaller positions in the screenshot. Here I zoomed out to get all my tickers on one page, so sorry if it's too small. But you can see that my average weighted PE is 25, my portfolio's average weighted beta is a nice low 0.42, which tends to mean that if we crash I'll probably hold up better than the overall market, but if we have a bull run then I'll probably not go up as much. And that kind of approach I'm happy with in retirement, but I'd rather get more alpha if I was younger. Those columns in the middle are month-by-month dividend payments over time, and everything to the right of the green current month, which is June, are all dividends I'm forecasted to get. On the bottom you can see the sum total of dividends I got in each month in the past, along with estimates for what my dividend income should be in the future. So basically I'll get about $9,500 this month, followed by $7,060, then $8,400, and then those 3 monthly payouts will keep repeating. Of course, if Duke raises or Altria raises or whatever, then those future dividend payouts will go up. Okay, now this section shows 2 rows of estimated dividend income growth over time. The top row are estimates for what I'm doing, which is spending my dividends to pay bills, and the bottom row is how my dividend income would grow faster if I was dripping it rather than spending them. So in year 10, if my 3-year dividend CAGR held, then this estimates that I'd be making $202,000 a year in dividend income, even though I was spending it all each year. And it looks like my non-drip dividend income is estimated to double every decade. So at year 20 it would double again to $400K, and then by year 30 it doubles again to around $800K a year. Or if I had been dripping that entire time, then instead of $800K a year it'd be yielding $2.1 million a year in dividends. Will any of that happen? Probably not, but even at a 4% dividend growth rate and a 2% inflation target, it still grows nicely. Anyways, right now I'm estimated to make a bit over $100K a year, which is about $8,300 a month on average, or about $1,900 a week, or $274 a day, or $11.42 an hour, every hour, year-round, which is a low estimate if you're converting it into a wage hour, since wages tend to have higher taxes and you can't work 24/7 and such. And then here's my portfolio value by sector, and we can see that tech stocks are about 21% of my portfolio, followed by consumer staples at 17%, energy at 11.7%, sin stocks at 11.2%, healthcare at 10.8%, etc. Now, the hope I have of showing you these videos is that you feel motivated to invest and stay the course. Don't get discouraged if your portfolio is too small relative to where you want it to be today. I'm confident you're probably underestimating where you could take things in a decade, so try to keep a super long-term mindset. And remember, happiness is not the absence of problems, it's merely the ability to deal with them. Anyways, I hope you enjoyed all that, and so now I'll close things off by shouting out my newest Patreon king named Martin, who signed up since my last video. I've been sold out of king slots for a while now, but he managed to snag one that just opened up, so I'm sold out again. Kings and aristocrats get access to my Dividend Spreadsheet product that I use in my videos, and they get to be in multiple private channels on my Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them publicly on YouTube, as well as let them vote on which thumbnails I should use for my videos, and of course they get more direct access to me. I also do a shoutout as you just heard, and I add them to my scrolling news ticker if I still have space on it. Kings also get a private 30-minute monthly voice chat on my Discord to talk about whatever they want. I'm sold out of my aristocrat seats, so instead I'll ask you to consider using my Seeking Alpha affiliate link, which usually gives you some extra perk when you use it and sign up to their service. I personally paid for Seeking Alpha Premium for multiple years because they're the best stock website on the internet. And now I'm grateful that they've agreed to sponsor me when I talk about them. I also have an Amazon affiliate link you can use if you click on it and then shop, and as an Amazon associate I earn from qualifying purchases. Oh, and if you appreciate when I do free dividend investing videos like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, I highly recommend that you join my free Dividend Discord chat server, which has over 10,000 dividend investors on it from 72 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.